Welcome back, investors, to Ticker Time News. I'm Adam, and equities took another beating today, declining for their fourth consecutive session in a row, at least when we're looking at the SPX and the SPY. With rates moving sharply higher, the Qs once again took the brunt of the pain, now down over 7.5% from its October top. By contrast, the S&P 500 and the SPY, it's down just under 5%. And the Dow, it's only given back just over 3% from that same pivot high. More to the point, the Qs actually made a new closing low for this entire bear market cycle today, just like we mentioned it could yesterday. And it's the only major stock market index to do so. In fact, it's the only major index to even come close to doing so. On the chart, this is the daily view for the Qs. Let me pull this up here just a little bit, and you can see just barely today's candle did hit a new low, a new closing low for 2022 at 260.49. Now, the intraday low, which would be this candle right here, you can see that it does go a bit lower, and my arrow isn't that great, but it does come down a bit lower. But that was an intraday low that happened in the middle of the cash session. This over here today, this is a closing low, and it is the lowest point at which the Qs have closed of all of 2022. All right, let's clean this chart up here just a little bit, and I want to talk about some support levels for where these major indices, the SPY, the SPX, the Qs, the IWM, where they found that support today. It's not far off from what we talked about yesterday. Now, the Qs, obviously, I'm going to go in here to the 5-minute chart. It found its low at the close today. Let me fix this real quick so we can get a better view on this. There we go. 5-minute candles. You see the chaos from yesterday on the left side of the chart, and then we had a gap down session this morning before the cash market opened at 9:30 a.m. Eastern, and then basically we hit bottom early this morning, and then we had a little rally thinking, well, maybe we're going to catch a bid and ride out of this, a scenario that we presented yesterday. But no, we just basically moved sideways, and then we sold off into the close. Now, all of the indices, the SPX, the SPY, the IWM, the MDY, they all look very similar to this. Kind of same pattern today. Kind of setting up for a, hey, what's going to happen tomorrow with the employment situation with that data that comes out? Did we sell off in preparation for maybe it's going to be a little too strong for the market's liking? That's a possibility. We'll talk about those numbers in just a minute. Let's see how that, yeah, it did good. I sold it off this morning just after the close when we started to catch this bid and ride up this morning. I sold out of that short position somewhere around there. So it was a beautiful, beautiful play. Let's see here. The rest of your comment, I didn't trade today, which is fine. Happy with the SPX short from yesterday. Absolutely. And that's perfectly fine. Absolutely nothing wrong with that. When you take your gains, don't regret what you may have got. Appreciate what you did get. So that's what I go by when I'm trading. And once I got out of that trade today, that was it. I didn't do anything else for the rest of the day because there just wasn't a trade setup here that I liked. You know, new 52-week lows for a lot of mega caps today, which wasn't very good for the Qs and partly why it underperformed relatively to the other major indices. But it moved sideways. There was really nothing here that caught my eye that said, hey, this looks like a good area to get in on. So I'm not in anything right now. It's a clean slate, and I'm waiting for that next setup to appear. We could get it tomorrow. If that employment data comes out tomorrow and it is hotter than expected, which I think it very well could be, then we might go a little bit lower before catching a bid, but we'll talk about that. All right, let's go back to the daily view here on the chart. And let's talk about a couple of areas here. Now, I wrote down these yesterday, so I'm going to reference them again today when talking about what to look forward to tomorrow. Now, I do believe the market doing nothing today was the market digesting the Fed yesterday. And of course, the employment data that comes out tomorrow, that is going to affect the market very much so. All right, let's pull this up here. Let's open it up so we can see it a bit better. I did add those couple of postmarks there to tag where the FOMC meetings were for October and September. I'm sorry, November and September. All right, let's open this up. All right, with the Qs right here, again, the Qs are at an interesting support level. Since it did make a new closing low today, that kind of just undercuts this low that was created right here. Right the day after the intraday low. So could the Qs, if employment data is horrible, as in good tomorrow, the market may not like that. And could we go and test that section, which right now, what is that intraday low? It was 254. So we're $6 away from that. We're not that far away. We could totally hit it. So for the Qs, I had written down 265. We went $5 below that. And that 265 area was based off of these lows over here. So I would probably say this would be the zone to watch. Where it's at right now, 260 to that intraday low of 254. If the market gaps down again tomorrow, this would be the zone that maybe, hey, you know what? The market sees that we are now getting even deeper. Could we potentially catch a bid and bounce from there to try to get back some of the undercutting of the weekly expected move right here, which is at 270. We're $10 away from that right now. I don't know that we're going to get back to that. Even if we do catch a bid from a gap down tomorrow, it's very possible that with the Qs, they are definitely underperforming relative to the other indices, and that has to do with the mega caps like Microsoft, Alphabet, and there was a couple others that set new 52-week lows today that we'll look at in just a moment too. So I'm looking at that zone, right? If we do catch a bid for the Qs, that could be a good entry point to potentially ride it higher. But tomorrow is Friday. Do you want to open a position tomorrow and then hold it over the weekend? I don't know. That could be a risky move, holding it over the weekend, because we have no idea what's going to happen over the weekend. We have elections next week, right? Yeah, we have elections next week on Tuesday the 8th, I believe. So what could potentially come out over the weekend that could really shake the market due to the midterm elections? So I'm not sure this is the weekend that you would want to hold over the weekend. So just putting that out there, just in case you are thinking about tomorrow. All right, let's go to the SPX, and then I'll go SPY and IWM. Now, the SPX, it found support at the 3,700 level today, and I had marked down 3,720 to 3,640 as two potential areas where it could catch some support, and it did at that 3,700 level. So we got that. That's pretty cool. Now, one thing interesting, where it's hanging out, it may be difficult to see, but all of these anchored VWAPs right here and the 20-day moving average are basically holding the SPX right in this narrow pricing range where it is and where it found itself today. So that's interesting because it's either going to turn out to be a bit of a resistance area, or this is going to turn out to be a significant support level. Which do you think it could be? I really think it's a coin flip on whether this could turn out to be support or resistance, because it's literally bouncing right back and forth between those anchored VWAPs and the 20-day moving average. And now we have a big disconnect, and this is one thing to point out. We've got a big disconnect from that 5-day EMA. We have to reconnect with that. And whether it's a big candle that shoots up to do so tomorrow or maybe next week after the midterm elections is anyone's guess, but we do need to reconnect with it. And that's one thing I'm watching, and why I'm watching for a bid higher. All right. Because we are so far disconnected. And, I talk about that thing like a circuit board. We've got to stay connected to the 5-day EMA. Just the candles work that way, and that's how the market runs. So it's like a circuit board, and if that connection's not made, that electric current's not getting through, and something could break. So watch for that potential as well. I don't know if it's going to happen tomorrow. Again, we've got that jobs data coming out. That could be a nightmare scenario for the market if it is just way too good. All right. So 3,700, I'm sticking with the 3,720. We basically closed at 3,720 today. I do find that pretty darn close to our 3,720 call yesterday of support. Watch for the 3640 area. That would be the next leg down where I think we could potentially see some support. And that's at the top of this blue band right here. Let me run a line across here. It's basically right here. My line's not too straight, but that's where that 3640 line is. I think there could be support there if we did go lower and really get disconnected from that 5-day EMA. All right, moving on to the SPY. The SPY yesterday, we said 372 to 365 as like a zone for the SPY, and it found support at 368 today and closed at 371. Now, you can see something very similar here. All of these VWAPs that we've got anchored to major, we've got it anchored to the bottom, the intraday low for 2022. We have it anchored to the FOMC meeting from September. We also have another anchor at the beginning of the quarter. So on October the 3rd, they're all lining up and matching up right here, right about this 370 area. So that's an important area to watch. And again, like with the SPX, is this going to end up being a major support area, or is it going to turn out to be a resistance area? Again, it's a coin flip on what the market could see here. Again, that employment data tomorrow is going to be key to how the market reacts tomorrow. But again, like the SPX, the SPY is really disconnected from its 5-day EMA. It's below its weekly expected move of 377. So we have those two things to contend with as well. I'm still sticking to that 372 to 365 zone as support for the SPY to catch a bid. Again, mainly because we are so disconnected from that 5-day EMA. We've got to get back to it. All right, moving on. Let me pull up the DIA. I don't really pull that up a whole lot, but this is what you would trade for the Dow Jones, that ticker symbol DIA. The Dow has been holding up so much better than everything else out there. It's just over 3% below its top from the rally. That top would have been November the 1st, by the way. So it is still within its weekly expected move. The lower end of that weekly expected move is at 316, and it closed at 319 today. So yeah, it could probably hold up, and it did barely connect with its 5-day EMA today. So, it's connected to its circuit board. this one could hold up into tomorrow, and then we go into next week. And since it has been holding up so well, all of its anchored VWAPs right here are all spread all over the place. So there's no consistency there with the anchored VWAPs to say, hey, maybe we've got a support or resistance area coming up for the Dow Jones. It's just been a really good start for, the month of October and so far in November. And that's mainly due to earnings. Earnings, a lot of oil companies still in the Dow have been performing really well, and I think have been holding them up pretty well. Now, as we go to the IWM, it bounced perfectly on its 20-day moving average today, which was down around the 174 area. And that's just 1 point off from what we called yesterday at the 175 area to find support. So that is really, really good. It also came back up to the lower end of its weekly expected move, which is also a positive sign. It broke above its 50-day moving average slightly today, but then it pulled back underneath of it to close under it. So it could probably just hang out here, move sideways if it wants to tomorrow, as long as the employment data is not too bad. So the weekly expected move is at 176.35, and it closed at 176.30. So literally 0.3%. No, not even 0.3 under that. My goodness. Barely. 5 pennies. Let's call it that. 5 pennies from the lower end of the weekly expected move. Now, also, we have to talk about the dollar today. Man, it did phenomenal. If you're ever bullish on the dollar and you want to trade the dollar, you can use the Dixie, DXY, or you can use ticker symbol UUP. UUP. Only if you're bullish on the dollar, because this thing broke out perfectly of this setup here. This was nice. We talked about this potential breakout yesterday. It ran into its resistance zone, which this red box up here, okay, which has a high right around 113.6 and a low area of 113.0. That is going to be the resistance zone for the dollar. It pushed in there today. The wick of the candle made it in there, but it closed at 112.98. So it's just kind of hanging out right below that. Could we get a push to break through it? Yes, we could. And then we could go test the 2022 high for the dollar, which is sitting at, what do we want to call this? 114.77. Is that where we're at? 114.77. Yep, that's the high for 2022. It could move up there. Adam, are you in the camp of stay away from FANG? Yes, I am. I think FANG was wonderful during the pandemic, but during the pandemic, it got way overblown. Meta Platforms is one example of why to stay away. It is just continuing to go lower and lower and lower. Look at what made 52-week lows just today. And that is your answer for why to stay away from the FANGs, at least for the time being. All right. They got too pumped up due to the pandemic, and now they're just a sinking ship. And it's a big reason why the Qs are underperforming right now. Their earnings right now, this earnings season, they're coming in and they're not so great. So I am definitely in the camp, and I should have put this up on the screen when I read that, but I am definitely in the camp of stay away from FANG for right now. I don't think it'll be stay away forever. Not at all. But at least for the time being, stay away. Oh boy. All right. So the and I'll look at those in just a moment. While we're this is on my mind, we'll look at what made 52-week lows today, and a lot of what was in Fang made 52-week lows just today. But real quick, let me finish this thought here on the dollar and rates. The dollar, it shot up, broke out. It's at resistance. It could go higher. Rates, both the dollar and interest rates, they rode their respective horses higher today. And it's no surprise then that the value growth ratio, and you can look at that by going to ticker symbol IWD and IWF, and you can get a ratio on value to growth, and that can be a guide for you, right? But that value growth ratio had another barn burner of a day, breaking out to new cycle highs. Now, as participants digest the Fed Chair Powell's comments indicating from yesterday that the Fed's terminal rate is going to go higher than previously expected, that sent the 2-year and the 10-year running higher today as well. The 2-year hit 4.75% and the 10-year hit 4.21%. Now the 2-year is at 4.72% and the 10-year is at 4.15%. But perhaps the simplest way to paint a picture of where are we in this market is on today's action among the 52-week lows. Let's look at them. Microsoft, MSFT. Let me get my, what am I doing? I'm clicking wrong buttons. I got my cursor on the wrong ones. And this is going to go and answer that question of why to stay away from things. MSFT, Microsoft. Microsoft is in that Fang group, or Fang plus Microsoft. Let's pull Microsoft up. New 52-week low today. The past 4 sessions, it's been down, 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 down. Look at this. This is just sad right here. And let me go down so you can see. Bottom right corner, 213.98 is the new 52-week low for Microsoft, hit today. It closed at 214.25, down 2.66% today, down another 1/3% in the after hours. Let's just adjust this chart here real quick so we can get a bird's eye view of this. Let me tighten this up. Microsoft was obviously a market leader all pandemic. I mean, look at this. Wow. Look at this. This had a $343.08. Wow. It had a high. It's a 52-week high, basically $350. And it has lost a whole bunch, down to $213 now. This is just going to continue to go lower. Man, that is just something. I honestly, you know, back here when this was making these all-time highs back here, I thought, wow, this is incredible. This is incredible to be this high. But then, I mean, boom, this thing has just shot down so hard this year because it got pushed so freakishly high during the pandemic. I mean, that is look at this right here. This is what you would call a blow off top. We have this low right here, okay? And this was October 1st, 2021. And it basically went straight up. That's a blow off top. And then it came to this topping pattern up here. That's what you call a blow off top right there. And it was just insanely high. You know, you hear that phrase, blow off top, right? That is the prime example of a blow off top. And I just, Stay away from it right now. Is it too late to get out now when Nvidia? So Nvidia, are you talking about Nvidia that way? Am I just reading that wrong? Nvidia sold. We around have sold. When Nvidia sold, we around have sold. I think I'm just misunderstanding what you're trying to say there. Is it too late to get out now? That's a really good question. If you're still in some of these big names that have dropped so significantly, at this point, no, CEO of Microsoft. At this point, it's a toss-up. This is going to go lower, yes, but you've already lost so much. Getting out now and then, getting back in a month from now or 2 months from now, is it going to save you that much in the long run? I think probably not, because I think that Microsoft, for example, I think it's getting pretty close to its 2022 low. It's going to go lower. And if we just go back here, the top, look at this on the volume shelf profile over here. Okay. We've got the candles coming out to here, right? And that matches up to right here. And then there's this one little area where they come out a little bit further here. So I think that right now we need to watch two places. Number one is when Microsoft was right here on these 3 support bounces, okay? That's right around the 195 area. That could end up being a very supportive low for Microsoft, 195. It's not too far off from that at 113, but that's still about what? Where are we? 95, 10, $15 a share. So that is a big chunk if you have a lot of shares. But the thing is, if it takes less than a month, because remember, if they are short-term shares, like if you've held those shares for less than a year, then you can sell at a loss. You have to wait for a month to pass before you can buy back in if you're selling at a loss. It's a wash rule that's in place. So selling now and then within a month, if it hits that low and then bounces back up, the bounce, it could happen really quick, really quick, and you could potentially end up losing out. Now, volume shelf profile tells me that that 195 area is going to be a very important low that will catch a bid. Definitely will catch a bid. The next area, though, is at 188, okay? And that's this top right here, right before the pandemic. The volume shelf profile sticks out there a little bit further. If it got that low, that would be an incredible steal for Microsoft, I believe, okay? So we're looking at a potential bottom for Microsoft, 195. And then if it ducked under that to the 188 level, I think that's a steal for Microsoft. And I think a lot of market participants will also believe it's a steal for Microsoft at that price level. Let's see here. I'm thinking of buying puts for protection. Absolutely. Absolutely. But one thing to keep in mind, even though I'm talking about these bigger ideas and bigger price points for Microsoft, let me point out one short-term problem, okay? With buying puts now, right now, say tomorrow's session for Microsoft. Let me zoom back in here. This would be a problem with buying puts now. There's a phrase, don't short in the hole, okay? Let me open this up. This is going a little slower. All right, come on. I know the chart's bouncing all around. We'll get it settled down here as soon as we get zoomed in here, okay? If you see here, and I pointed this out when we first started to talk about Microsoft, it's had 4 sessions in a row that it has been down, okay? And with the old adage of don't short in the hole, there is a short-term support area right here for Microsoft where it's at right now. This let's give it a zone here, 314.5 down to, I'm sorry, not 314, 214.5 down to 212.5. That is a support zone for Microsoft. And if we measure the past 4 sessions, how far has Microsoft fallen over that time? All right, let's get the measuring stick. And let's measure down to where we are right now. See, Microsoft has already dropped nearly 10% over the past 4 sessions. That's a big number in a short period of time. So Microsoft is likely to catch a bid right here between the 212 to 214 a share zone and go higher in the short term. But in the longer term grand scheme of it, this can definitely go lower to that 195 area as kind of like an absolute support area for Microsoft. So you do have to be careful if you were just going to jump in and buy puts in tomorrow's session, because you would be shorting while Microsoft is already in a hole. So you'd want to wait for Microsoft to bounce, since it is in a short-term support zone, before shorting, before buying puts, right? For example, if we would have taken, Microsoft in the hole on, let me get my highlighter back out. When we hit this top right here, and then we sold off, well, 1, 2, 3, 4 days in a row of being down, shorting right here, that would have just made your losses grow, right? Because we had this nice little rally here. And then we sold off. Now, where we are currently is lower than that point when you could have bought puts. But if you just wait just a little bit longer to catch a bounce, then if you want to buy puts to protect yourself, that to me makes a little more sense than buying puts in this situation. So just something to think about. Let's see here. What do we have? Where would you feel comfortable adding Microsoft and Amazon? I'm staying away from Alphabet and Meta. Okay, Microsoft, again, short term, it could catch a bid right now at the 214 to 212 zone, but that 195 to me is a sweet spot, absolute sweet spot. And And then if it did break down a little bit lower and get down to that 188 area where that other support area would come in for Microsoft, that to me, in between there is, I would gobble up for long-term, for a long-term play on Microsoft at that at those price points, right? 195 and lower, it would just be incredible to get Microsoft for that, because you're going back then to nearly 2019 highs for Microsoft. I mean, it's really February 2020 highs that you're kind of working with there at that point. Maybe April 2020 highs to be a little more precise. But that is still a steal. Trying to get the words out for Microsoft, because you're catching it when before it went on its hyper bull run for the pandemic, right? So to me, that would be a good entry point for Microsoft. Okay, let's see here. Let's get this comment going here, and then I'll look at Amazon too. So I have it on my notes here to look at Amazon. I originally bought Microsoft for 35 in 2009. My biggest mistake was to sell in 2020 panic. I bought again back too late. So my current position is at a loss. I am not, don't use that word again, Adam. I am not selling again. That's good. Good for you. Wow. I couldn't imagine having Microsoft for 35 in 2009. Incredible. The pandemic was scary, and big falls in the market cause even bigger falls in the market for the exact reason that you just described. People panic, and their fear gets the best of them. And that fear causes people to sell out, trying to keep as much wealth as possible and keeping from that loss. It can be devastating to feel it. So I understand completely your point there, and it's an excellent point. Excellent indeed. Do not sell. Do not. Because what we're talking about here, $10 to $15 a share as a potential move lower, you could literally start to dollar cost average from this point to that potential low and be in a great position for the next bull run, right? Or for the next decade, or for the next 20, 30, 40, whatever years. That would be incredible. So if you are playing this for the long term and you're not specifically trading, I know a lot of what I talk about here is for the trader. If you are investing, dollar cost averaging, putting a specific amount in every week, every 2 weeks, every month, getting into that rhythm of doing that, you would be bringing your cost basis down lower and lower and lower. Meaning the next time we start to rally and we go on a nice decade-long bull run, 15, 20-year bull run, it'll be that much sweeter. So if you are investing and you are more investing minded, consider dollar cost averaging to bring that cost basis down lower. It's wonderful. It is absolutely wonderful. These are the times where you would want to start dollar cost averaging, because you'll do so good over the long term. All right, I just wanted to make sure I was separating the trading logic versus the investing logic, because they are radically different, and you do approach the market with a completely different mindset depending on your goal, whether it is trading or whether it is more investing for the long term. So thank you for that comment and reminding me of that as well. And you are absolutely welcome. I'm glad we were able to connect here and have that conversation about Microsoft. Okay, let's go here now. I want to go a little bit. Oops. I want to get that highlighter out of here. Let me clean this chart up here right quick, and then we will move on from where we are. Okay. A couple more buttons, and we'll have this cleaned up. One more. There we go. All right. So another 52-week low today just happened to be Amazon. AMZN is the ticker. And let's go have a look-see over here and see what's going on. See what's going on with Amazon. This has just been, such a big drop. But quite honestly, we talked about this months ago about Amazon. I see your comment there. I just missed it. I want to put it up there because it was kind of talking about Microsoft too, or at least in the context of it. I would have panic sold in 2022. It was difficult. It's very difficult when you are a long-term investor and the market is falling so fast. I mean, just look at Amazon over the past week, right? Earnings caused a big pullback in Amazon. And it even started about 3 sessions before earnings where Amazon started falling. Once something starts falling, it is only, how should I say it? Falling, selling begets selling, begets selling, begets selling. And the same thing can be true for buying. Once something catches a big, people FOMO into it. And I guess I could say when something is falling and is being sold off, people FOMO into selling as well. And it is a real logic there. And it just takes over. And when you're in this market, it is very important to take emotion out of it. And I know that can be so hard at times, trying to take emotion out of this when you see your portfolio size shrinking on a daily basis. It can be very fearful and very hard to think, I don't know. Do not sell. I need to buy right now. I need to buy while the market is falling. It is really hard during a very uncertain situation like the pandemic in 2020 to even have that mindset. But it is important to have that mindset. Now, a bear market is a little bit different because bear markets are more extended downturns than just what happened in 2020. 2020, it took about a month or two, and we were top and then bottom and then back up to where we started, within a month or two. So it was very short-lived. In bear markets, they're a completely different beast than some black swan event causing the market to sell off. So clearing the air with that one. I think even Bill Ackman panic sold everything. Yeah, that's funny. Absolutely. I think so. All right. So Amazon here. Let's go down here and you can see bottom right side of the screen, 89.02 is the new 52-week low for Amazon. Its 52-week high is 188.11. Yeah, big time. Amazon, again, it's one of those FANG companies. It got overvaluated during the pandemic because people were staying home, shopping online, buying on Amazon, having it delivered, not leaving their home. And yeah, it went on one heck of a ride. I don't blame Amazon for doing that. It just worked out into their favor. But now it's not really working out to their favor. People are trying to find the best deals. And whether they go to a physical brick and mortar store to get that best deal, it's up to the consumer. And right now, it's just not in Amazon's favor. And that's why. But let's see if we can't find a specific area here for Amazon. I got to fix this chart real quick so we can get a bird's eye view here and go a little bit more into this. little bit more in depth into this. Now, if you notice, there's this red line here to the right of the chart for these candlesticks where there was this support area. It was right here. There was a lot of bouncing off of that. That's right around that $100 a share level, a big time psychological number. Now, remember, a lot of these companies, Amazon, Alphabet, they I just lost my thought here. Oh yeah, that's right. That was my thought. Hold on, because I can pull it up right here, and I want to show you. They did stock splits, and you can see Amazon stock split right here, 20-for-1. So Amazon at $100 a share, it's a psychological number, but it wasn't always $100 a share over the pandemic. Remember, a 20-for-1 stock split is a big stock split. That means for every one stock you own, you will then have now 20 stocks, 20 shares, right? One share then turns into 20 shares. When that happens, and I think a lot of these big mega cap companies saw this coming, Alphabet included, saying, pandemic, our economists on our team, in our company, think that a slowdown is coming. The market cycle is working its way around. The government's stimulus put off that market cycle, and the end of the market cycle where we go into a recession. The government stimulus over 2020 and 2021 pushed off the recession to 2022 and 2023. So I think these big companies saw that coming, and they thought, well, you know what? We can't have $2,000 a share stock anymore. We need to lower that. We need to get our shares to under $100 so people think they're getting a good deal, and they will continue to invest even in a bear market because we've cut our share price down by issuing more shares, right? By doing stock splits like this. I guess I misspoke there. They're not issuing more shares. They're just, dividing up those shares even more. So that's one thing to also remember about these companies. And I almost think, since so many of them did it, Apple included, I think that is a pretty big reason for why they did it. They could potentially have seen this coming. And it's a psychological game they are playing on us. Bear markets are exhausting. Yes, they are. Because when the market is not going in your favor and then it continues to go in the opposite direction of where you think it's going, it can be very frustrating. What did I hear? Oh my goodness, there was a quote that I heard. It was recently. It was within this week. What I cannot remember the quote now, but it was something to the effect, and I'm totally messing it up, so the point won't get across. Bear markets, they will either shake you up or wear you up or something like that. I don't know, but you either get out because the market is dropping, or you get out because you're just worn out from the market dropping. So I just butchered the quote, so maybe I'll try to Google it later. But they definitely can. Okay, looking at Amazon right here, that $100 level, if we go back to September of 2018, all right, stock split adjusted, that was the peak for Amazon. If we look at the April of 2019 high and the July of 2019 high, $100 a share was the peak. Again, stock split adjusted $100 price point, because it wasn't $100 back then. So it breaking below $100 was a big deal. So now what are we looking for? Are we looking for the pandemic low as a potential low? Wow, that would be something if we did. And quite frankly, I don't think we're that far off from it. Pandemic low, stock split adjusted here. Let's let this come into play here, come into focus. Oh my goodness, $84, $83 a share was the pandemic low, and we're at 89. That is not very far off, and that could totally be a price point where buyers step in. Wow, I didn't realize we were getting that close. All right, so looking there, Amazon's at an interesting spot right here in the $89 a share area. If we look, there was a ton of support even before the pandemic right along here, okay? A lot of support right around the $86, $85 a share. I think that will be an area where buyers step in. $85 a share for Amazon. I think we'll definitely catch a bid. If we look at the volume shelf profile, let me scoot this over just a little bit. I don't want to mess up what we have here, but look at the two big spikes on the volume shelf profile. That's right around that $100 a share at the top and going down to about that $87 to $85 a share price point. So that is definitely going to get buyers to step in. $85 a share. It looks like a real comfortable place if you're trading this thing, and even if you're investing for the long term, because Amazon in their AWS, that's the future right there. AWS is going to be a big hit for Amazon. I mean, it already is proven to be. But yeah, this looks like it could be a very interesting area. 85, 84 dollars a share there. And then if it really wants to undercut, we've got some interesting support right there. And then we've got this kind of downsloping support here to an ultimate low. But that's getting down to about $70 a share. I don't think we're going to see that anytime soon. I think that 85 is going to be a sweet spot for investors and a round number, right? A round number where we could get some bids happening for Amazon. Okay, so that goes back to answering the question about Amazon. Let's see here. I didn't keep up with these comments. I started talking. I lost all my profits this year because I did stupid things. Well, we all make mistakes in the market. All of us. We all do. As long as we are continuing to learn from those mistakes, they're not stupid, at least in my view. As long as we learn from them, they're not stupid. So don't beat yourself up too bad. I forgot my password. Oh, wow. To my brokerage, 2009 to 2020. Best idea sometimes. That worked out. That worked out real well for you. 2009 to 2020, losing your password. Yeah, but then it doesn't allow you to buy in dollar cost average over that time either. So it could have been much bigger reward there for you. Let's see here. What do we have next up? Compare Microsoft, Apple, Amazon, and Alphabet price is high. Yeah, it is. It is. And their price, they're coming off extreme valuations. All right, let's pull up Alphabet here. It's another one that hit a 52-week low just today. Meta Platforms also hit a 52-week low today, but I'm not interested in Meta Platforms right now. Their business plan right now is to build and grow the metaverse, and that is going to suck a ton of cash flow away from Meta Platforms. So I don't think that stock's going to do really well anytime soon. Alphabet here, GOOG or GOOGL. Let's see here. Got to get my cursor right. GOOG, and then you also have GOOGL. I typically use the GL over G. Now, Google, Alphabet, hitting that 52-week low today. On the bottom right side of your screen here, you can see 83.45 is that 52-week low, and that 52-week high was 152.10. Let's see where an interesting place for Alphabet could be here. Let this chart load, and let's pull this up right here. Get this next comment. If QQQ goes down more, you think Amazon will stop falling at 85? The Q is at an interesting place right now. I think it's at a short-term bottom, or at least close to a short-term bottom, at least where it could catch a bid, right? Because it has been oversold relative to the SPY, especially to the DIA, which is the Dow Jones, or the IWM, which is your small caps like Russell 2000. So it's definitely in an interesting place where in the short term, I think it could catch a bid soon. Now, tomorrow we get employment data. That could be bad for the overall market, and send it lower. Let's see here. For Alphabet, look at that. We had support right around the $85 to about the $84 zone here. And this was the December 2020. And then we can go back to the September. Did I get that right? December of 2020. Okay. And then this peak here was September of 2020. So we just broke below that. So we need to go find another place that's a little bit lower. And the volume shelf profile is telling me to watch out for this top right here, which is about 77, to this low right here, which was a September of 2020 low, and that's right around the $70 area. So for Alphabet, we're looking $75 to $70 a share. That zone, that could be the next supporting low right here. Since this 84, 85 zone was broke today with the new 52-week low, again, short term, I could see Alphabet catching a bid here because it's been falling so rapidly since earnings, right? Several days in a row now of Alphabet being down, just like Amazon, just like Microsoft. They could catch a short-term bid. However, over the long term, maybe Q1 of 2023, maybe we see the bottom at that point, and we're looking $70 to $75 a share as that next low point that I think we could catch a bid for Google, or Alphabet, I should say, before mine goes off over here and starts chit-chatting. Okay. All right, that's Alphabet right there. And then, of course, if it wanted to break that $70, $75 support zone, man, it looks like we could potentially I hate to say it, but the pandemic low, which looks to be around $55 to $50 a share. That's real low. But the volume shelf profile, if that $70 a share is broke, there's an air gap right here taking us down to the pandemic low. So yeah, that would be interesting. Oh my gosh, that would be real interesting. Okay. I'm glad we're talking about these bigger themes and ideas here. This is pretty neat. This is pretty neat indeed. And I greatly appreciate all your comments too and questions. I'm glad we're here so we can do this. All right, let me clean this chart up here a little bit, and then I want to move on with a couple more thoughts and look at the expectation for tomorrow with the jobs data that's coming out. Just a couple more clicks here. Again, $70 to $75 a share looks to be very interesting. But again, just like Microsoft, Alphabet could be catching a bid really, really soon just because it's reaching an oversold area, right? And whenever stocks are oversold, they will catch a bid. Buyers will step in. Just like when they become overbought, sellers step in and they sell. And then we go through the cycle again. So just keep that in mind, right? Keep that in mind. It's been a pretty big sell-off here for Alphabet, for Microsoft, and Amazon in the short term, which should mean they're getting oversold and they'll probably catch a bid very, very soon. All right, let's see here. All right, I just wanted to get dialed back in here on a shorter term. Because look at that. Since earnings, big gap down there from earnings. What did we have? Nearly a 10% drop due to earnings. And then, wow, even further since then. Interesting. You are very welcome. Here every day, the market is closed to talk about whatever you want to talk about. So I'm always here to answer your questions. Never run from them. Okay, let's see here. Since we're talking about mega caps, let me pull up this MGK, which is the mega cap. Oh, I got to get my cursor back over here on the right screen. All right, MGK is the ticker, and that's your Vanguard Mega Cap Growth ETF. It's what I track for how well mega caps are doing, and they were just another sticking point for the market today. This was down 2.2% on the day. Compare that to the 1% drop in the SPY. So definitely a big difference between the mega caps and the broader market. Now, the dollar, we talked about it. It went bananas today. Just like we mentioned as a possibility yesterday, we talked about that. We talked about yields rising, just like we talked about yesterday. They both were poised for a breakout, especially with the, I want to call it a hawkish pivot from the Fed yesterday to kind of throw it back at everyone saying that, hey, maybe there's a pivot coming, because there definitely wasn't. So yeah, let's see here. Where should we go next? Oh, silver, surprisingly, it was actually in the green today. And speaking of that, there were some sectors in the green. I haven't talked about the sectors yet. So about half or a little less, let me open this up here a little bit more so I can get all of the sectors in here. There they are, right side of your screen. About half, maybe a little less, of the sectors were in the green today, or the red, whichever way you want to throw it. Information technology, ticker symbol XLK, it was down the biggest, obviously, 3%. We looked at that. They were down 3% due to the mega caps that we looked at, Alphabet, Microsoft, all being down. Meta Platforms being down, even though it's not in there. And then the biggest winner was energy. And if we look here, energy was up 1.9%. I'll pull energy up. I do think energy, like we talked about yesterday, if China does open back up, they're going to stop selling refined oil, gas to Europe. They're going to keep it for themselves. That's going to cause prices to go up in the oil sector, which is going to cause prices to go up for the energy sector. And just how it works here. Now, it's been on a nice October run, had a little hiccup here, reached its high on November 1st, but today we finally got that little bounce. It was to be expected. It was disconnected from its 5-day EMA. It's reconnected, so all is well there. Now, we had positive earnings today that helped. ConocoPhillips, ticker symbol is COP. They had good earnings, which was to be expected. A lot of the oil refineries, energy sector companies did well. These guys were up 5.7%. We had Marathon Oil report good earnings today. They were up over 5%. So they did really well, which is something that we've been saying for the past couple of weeks. Watch out. These things have been on a good run lately. We could get a sell the news, and we got over here, look at the bottom right-hand side of the screen, we got a new 52-week high today for ConocoPhillips. So these oil companies have just been doing really well for the energy sector. Now, that's the sectors. One of the data points that we got today, and this will go into tomorrow as well, was the weekly initial claims. It came in at 217,000, where it came in last week, even though that was revised up to 218,000. And that was better than expected. The expectation was 222,000. So that means jobs are still strong. Weekly continuing claims came in slightly higher than last week at 1.485 million. So the key takeaway here is that the low levels of the initial claims shows a tight labor market still, and a data point for the Fed that will keep the Fed on a tightening path. Now, look here, Friday, November 4th, which is tomorrow, we have 8:30 a.m. Eastern non-farm payrolls, okay? We have the expectation. Oh, give me one quick second. I forgot which side was which. Okay, that's right. Expectation, 205,000. The last reading last month was 263,000, okay? We also will get the unemployment rate. It's currently at 3.5%. The expectation is for it to stay at 3.5%. This has the potential to turn the market on its head again for tomorrow. Why? Because if jobs come in better than expected, if we get, instead of 205,000 as expected, if that level comes in at, say, 175,000, that means less people lost their jobs, meaning the labor market remains tight. What is that going to do for the Fed? Just like with the weekly initial claims being better than expected, that means the Fed's going to continue on their path to tighten and potentially over tighten. So we could also add to that, continue to raise rates, go farther than they expected. just like they said yesterday. They're going to have to go further and higher than expected. So maybe that 50 basis point rate hike that everyone was talking about for December, maybe that doesn't happen now. If the job market remains strong, if CPI data comes in and says, well, we went up again, the Fed's not going to slow down if those two things continue to happen. So 8:30 a.m. Eastern, we'll get that data. And then we have at 10 a.m. Eastern, we've got the Boston Fed President, Collins. She's speaking. We'll see what the Fed is going to talk about. And then next week, we've got some Fed speak as well. That will be interesting to see what are they going to start talking about after the FOMC meeting. What are their thoughts now? Have they changed since before their blackout period, before the FOMC meeting? Have their thoughts changed, and have their public comments change? Okay. That's everything for today, ladies and gentlemen. That's everything for my notes. I'll give you a couple minutes. If you have any questions, plug them in now. Although we've been doing pretty good about talking through with your questions as we've moved through my notes here. And everything's looking pretty darn good. Again, like yesterday, since the market has been selling off, the jobs data will affect how the market opens tomorrow. But then the market could try to catch a bid off of the support levels, that come in tomorrow. And I'm still looking at roughly the same numbers for all of the indices. We went through them as I was during yesterday's live stream. So we're looking at 3,700 for the SPX, maybe down to 3,640 potentially. The SPY, 372 to 365. The Qs, it's at 260. It hit a new closing low today. Maybe it goes a little bit lower tomorrow. If that jobs market comes in hot, we could see a gap down in the morning and then maybe catch a bid late morning. That could be a potential play. But don't rush a trade. Don't force a trade. Wait for the setup to be there, okay? And then do it. All right, so that'll wrap it up for today. I greatly appreciate each and every one of you. If you could do me a favor and click that like button and share this video with a friend. Those two things help out greatly, more than you can imagine. And if you like the perspective, you want more of it because knowledge is key, click the first link in the description and check out what we have to offer. You may find it valuable to helping you understand and navigate this crazy market. So again, I thank you so very much. You are very welcome. I will see you tomorrow after the market has closed to talk about what happened, why it happened, and what to expect going forward. Take care, everyone, and I'll see you in the next video.